In today's video, we're diving deep into a story that's shaking Wall Street to its core, how AMC is flipping the script on short sellers and creating a financial battle that's redefining the stock market. If you've ever been curious about what's happening behind the scenes with dark pools, synthetic shares, and the astonishing resilience of AMC, this video is for you. Let's unravel the facts, dissect the moves, and explore what this means for retail investors. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads, and also enter our giveaway. But everyone remember, this is not a financial advice video. First, let's address the recent headlines about AMC. The company has not only managed to survive, but is now gearing up to thrive. Analysts predict that next year could bring one of the most profitable periods in AMC's history, driven by a massive resurgence in box office revenue. But what's truly fascinating is how this impacts the short sellers who bet against AMC. As retail investors continue to hold their shares, short sellers are finding themselves trapped in a web of their own making. Let's rewind a bit. Citadel, a key player in the hedge fund space, recently had to secure a $1 billion loan, followed by another $500 million, and even sold a portion of their company, a move unprecedented in their history. While Citadel claims profitability on paper, their actions suggest otherwise. These loans and sales highlight a critical issue. They're raising capital not to expand or innovate, but to meet obligations and maintain liquidity. This situation underscores the immense pressure short sellers face as they're forced to keep their positions afloat. Here's the crux of the matter. Short sellers often project an image of profitability, but the reality is more complex. Much of their capital is locked in positions that they can't unwind without incurring significant losses. Even if they have free cash flow, a large portion must be allocated to meet margin requirements. This over-leveraged state has created a precarious situation for short sellers, especially with stocks like AMC and GME GameStop. One of the main reasons AMC has been able to put pressure on short sellers is its survival. If AMC were to go bankrupt, short sellers wouldn't have to cover their positions, as the shares would effectively become worthless. But as long as AMC remains operational and continues to improve its fundamentals, it forces short sellers to double down on their synthetic positions. This strategy requires them to inject more money daily just to maintain their stance, leaving them in a perpetual state of financial strain. Retail investors have played a pivotal role in this scenario. Their unwavering commitment to holding AMC shares has trapped short sellers in a corner. Unlike institutional investors who may trade frequently, retail investors have demonstrated remarkable patience, effectively starving short sellers of opportunities to exit their positions. This collective action has created a unique dynamic where short sellers are increasingly over-leveraged and unable to cover their synthetic shares. But this battle is far from over. The financial industry has long been criticized for playing shell games to avoid accountability. For instance, Citadel was recently fined $7 million by the SEC for mismarking short and long sales due to a coding error in their automated trading system. While $7 million might seem like a significant amount, it's pocket change for a firm of Citadel's size. What's troubling is that these errors, intentional or not, have likely resulted in profits far exceeding the fines imposed. This lack of meaningful consequences perpetuates a system where bad actors can continue to operate with minimal risk. Looking ahead, there's hope for stricter regulations. With new leadership at the SEC and increased scrutiny of market practices, we may see measures aimed at curbing abuses like naked short selling and failures to deliver FTDs. These regulatory changes could bring much-needed transparency and fairness to the market. For example, derivatives, which are often used to manipulate stock prices, need tighter oversight. The sheer scale of these instruments is staggering, with major banks like JP Chase and Goldman Sachs holding trillions of dollars in derivatives. This over-leveraged environment is a ticking time bomb that underscores the need for reform. One of the most concerning practices is the use of dark pools, private trading venues, that allow hedge funds to execute large orders without impacting the market price. While dark pools were initially designed for institutional trades, they're increasingly being used to manipulate stock prices. For instance, a massive buy order for GME worth $700,000 was routed through a dark pool, effectively neutralizing its impact on the stock price. In contrast, sell orders are often executed on lit exchanges, creating downward pressure on the stock. This imbalance distorts the market and disadvantages retail investors. The implications of dark pool activity are profound. When trades occur in dark pools, they don't contribute to the stock's price discovery process. This means that even if millions of dollars are invested in a stock, it won't reflect in the price if the trades are routed through dark pools. Conversely, smaller sell orders on lit exchanges can create significant price drops, amplifying bearish sentiment. This tactic is a clear indication of how hedge funds manipulate the market to maintain their short positions. Adding to this complexity are synthetic shares and FTDs. Synthetic shares are essentially fake shares created to fulfill short-selling obligations. FTDs occur when sellers fail to deliver the shares they've sold, leading to further distortions in the market. These tactics are not just unethical, but also highlight the desperation of short sellers to suppress AMC's stock price. The longer this continues, the more apparent it becomes that short sellers are trapped. Recent reports also reveal challenges in locating shares for recall. For example, a Fidelity user noted that GME shares were slapped with a hard-to-borrow warning, indicating a shortage of available shares. This shortage complicates the settlement process, as brokers struggle to find the shares they've lent out. If institutions are forced to recall these shares, it could trigger a cascade of financial disruptions, further tightening the screws on short sellers. The battle between retail investors and short sellers is not just about AMC or GME, it's about exposing systemic flaws in the financial market. Retail investors have shown that collective action can challenge even the most powerful institutions. By staying informed and united, they've turned the tide against short sellers, proving that transparency and accountability are not just ideals, but achievable goals. As we wrap up, it's clear that AMC's story is far from over. The resilience of retail investors, combined with growing awareness of market manipulation, is driving a shift in how we view the stock market. This isn't just a financial battle, it's a movement for fairness and transparency. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.